Hello and welcome to another episode of Policy and Profits after a brief holiday break. Anthony Esposito here from Island Capital with EJ and Tony. EJ, how are you? The economic extraordinaire.
I am hanging in, Anthony. It's been a crazy couple of weeks with data, and as you know, crazy couple of weeks with market volatility. So I am sure we will have plenty to talk about over the next few minutes.
Yeah, we absolutely will. And there's been a lot of, I have to be honest with you, there's been so much news and disappointing news, even coming out of California over the past 2 days with the fires. It's an overwhelming amount of policy blunders and disasters and catastrophes that it just seems like more and more, I'm sure not by design, but more and more President Trump is just, it's just a train wreck that he's going to be taking over in just a few days from now, in 11 days from now. So, I know we wanted to start by kind of looking at the markets, and we're gonna set that up with some of the inflation fears because we're seeing that flow into the 10-year yield. We have the 10-year yield up at 4.6%. The 20 actually tapped 5% yesterday. So one interesting angle that you had, and we have a couple of things to move through, and we're going to end with kind of a broader stroke look at the markets and then take a look at what's going on in California and how scary our leadership is in some of these state and local jurisdictions, in addition to the current White House. Money supply is something that's come up. It's not talked about all that much. We talk about the debt, we talk about deficit, kind of repeating themes. But when we talk about money supply, I don't see it out there a lot. You had some great charts up recently out on X. And the first one is the monetary base and where we stand. We want to roll through a few, but as we do, talk to me about what the M1, M2 are, what these charts are showing, and kind of how this is affecting inflation and what the trend is, because this is something I don't think people are looking at enough.
Sure. So it's really actually surprisingly difficult to measure something like the money supply. And part of that has to do with the fact that, we are very much in a digital age. So there's actually not that much in terms of physical cash. I think it's something like $2.5 trillion, and that's it. So the vast majority of what we would call money today isn't actually, again, physical cash anymore. Years ago, it used to all just be gold coins and a small percentage was in banknotes. Today, it's all banknotes and what are more or less useless coins, or worthless coins, I should say. So the vast majority is all just digital. All right. But even when you look at the digital side of it, what do you actually want to count in the money supply? And this is where the distinction between those different measurements come in. So do we just want to count the amount of money that people have in checking accounts, for example? Do we want to include things like money market accounts? Do we want to include all different kinds of what in other discussions would really be called investments? So depending on what you want to classify as part of the money supply, even things like bank reserves, this will all affect that measurement. However, what we've seen broadly is all of those things increase. Now, we should note that a few of them have trended down over the last year or so. Everything is way, way up from before the pandemic. And so one of the things you can see in this chart actually is during the first Trump term, the Fed and the Treasury were more or less working together to bring down the money supply. This is part of the reason why the Trump economic miracle was just that, a miracle. The Fed was tightening the money supply, shown here as the monetary base. And then all of a sudden you get to COVID and obviously all hell breaks loose. The Fed buys literally trillions of dollars of newly issued government debt. So some of that was spent, some of it wasn't.
I'm really sorry, EJ. So that dip down in 2018 to 2019, heading into 20, from about 4 trillion to just above 3 trillion. That's the tightening of the money supply you're talking about, right?
Yeah, exactly. And what you can see before that, it's steadily increasing right until just before 2009. The reason for that is the monetary base is basically just growing with the size of the economy. It's growing a little too fast, but not terrible. So that's why you didn't have that much inflation in the early 2000s. You get the huge spike as the Fed tries to bail out things during the housing, the mortgage meltdown, the housing collapse, and all the fallout that came with financial derivatives. And then each time the Fed steps in with another round of QE, quantitative easing, or some other euphemism for creating money, that's where you keep seeing these steady spikes. And sure enough, in yet another election year, 2012, they're doing it again in a very, very big way, where they go back to buying tons and tons of mortgage-backed securities to try to buoy the housing market. And then you can see for most of the the second half of the Obama years, they more or less held the monetary base steady. Right after Trump gets into office, though, you can see things really start to decline. Again, this is the Fed really tightening and trying to put the screws to the economy, even though there was no inflation. Their inflation was no worse in 2016 and 2017 than it had been 4, 5, 6 years prior. So it's kind of interesting, to say the least, that the Fed has this drastic change in policy. Now, again, COVID, that's where we get the, more or less the everything bubble. The Fed is buying like crazy. We get this huge spike in the monetary base. And then it actually continues even after 2020, largely because the government keeps issuing so much debt into 2021. You see the spike there in, I think it's about the summer of 2021. And then things start to come down as the Fed takes its foot off of the gas. We trended up basically all of 2020. That was a part of the reason why we then later saw a rally in equities, but we have been trending down. And the reason why this component, or this, I should say, measurement of the money supply, the monetary base, has been trending down is not because M2 is declining. It's because bank reserves have been declining. And bank reserves are actually very tightly correlated with a lot of equity markets, including the S&P 500. And this is part of the reason why I give a lot of credence to your modeling work, Anthony, that shows that we might want to have a more bearish outlook than bullish right now on an index like the S&P. What tends to happen as those two things start parting ways, that is bank reserves and equities, what almost always happens is not that bank reserves catch up, it's that equities catch down and stay down until bank reserves start picking up again. There's a lot of different reasons for that. Has to do with how the money supply is pyramided. In other words, when you put money in deposit, or I should say on deposit at a bank, the bank then lends out 90 cents of that. It's creating money from your deposit. Other people are going to take that 90 cents, put it on deposit in their bank. 90 cents of that gets loaned out. Now it's 81 cents, et cetera. So as you start to reduce bank reserves, as you start to reduce that portion of the money supply, you get this cascading effect. And again, a lot of that is playing into equity markets, especially when we're talking about equity markets that where margins start getting involved. So that's essentially where we are right now here with the monetary base. Again, the big decline that we've seen over the last year has been not because M2 is coming down, but because bank reserves have come down.
Now, can we call, and forgive me, the bank reserve chart, the chart we just had up, could we consider that M1? So just dollars and coins on reserve in circulation, and then M2 is going to be a bigger number, I would assume, as we start to include other assets and other reserves on hand, or maybe that aren't as liquid, but they are within, they're in the system as liquidity, but not as immediately liquid. Is that the M1 supply we just had up, just bank reserves, dollars and coins?
So this is the monetary base. This is going to be your M2, but it's also going to include those bank reserves. Again, okay. Bank reserves, you may say, well, why is that not an M2 to begin with? The distinction here is that if a bank has money parked at the Fed, that money is not immediately available for lending, right?
Okay.
It serves functions as collateral and all different kinds of things. But that is not money from which the bank can make loans, so to speak. Okay,
so from the year 2008, sub 1 trillion, and the bank reserves actually spiked to over 6 trillion from 2008 to 2022, 21, 22, right? That's what we're looking at.
So you can see the monetary base just absolutely explodes. And you may say, okay, we should have had, Weimar Republic level inflation as a result of that. And the reason we didn't is because a huge portion of this monetary base it ends up not going into circulation. In other words, and look, we've talked about this before with paying interest on reserves, and also now reverse repurchase agreement facility at the New York Fed desk. What the Fed is essentially doing is creating money for the Treasury to spend. As soon as the Treasury spends it, it ends up in a bank account somewhere, and then the bank parks the money at the Fed because the Fed is paying them interest to do so, and it's a risk-free rate of return. So why not take that?
Yeah.
That's what's been happening, and that's one of the key reasons why ever since you see this initial spike from 2008 to 2009, and then obviously things keep going crazy, we've had such anemic economic growth.
Yeah.
A huge portion of our monetary base is no longer available for the private sector to borrow and to use for capital development.
And we're still seeing a massive spike in inflation, and it's still not available. All right, so then we go to the weekly M2 data that you had up. This was from October of 23 through the end of 24, so October, November of 24. So talk through this M2 supply.
So again, we see the big spike initially in early 2020. Right. It's, if we had stretched this further back, you could see it coming down as the Fed tightens a little bit. But whatever the case, despite that small drop, it has a huge increase beginning in early 2020 as the Fed is just going on its money printing spree. And then that continues a very rapid rise until I think it's about October of 2021. That's where we see the peak, and then the Fed begins to allow M2 to decline as it sells off its balance sheet, as it tries to bring money supply and demand into better balance, given where it wants interest rates to be. However, you can see as soon as we get to basically early 2023. M2 pretty much stops declining. There's a little bit of volatility there, but it pretty much stops declining. By October of 23, we begin the upward trend. And the scary thing is the fact that what we're essentially observing now is a faster than normal increase in M2. So again, you would theoretically want M2 to grow at the same rate of the economy if you want prices to stay the same, because you want the balance of prices and the balance of goods and services in the economy. You want that to stay equal. If you double the amount of goods in the economy, you also want to double the amount of money. And then that relative relationship stays the same. That's how you get stable prices in the long run. This is why gold works so well as a form of money for literally so many centuries, for millennia, actually. It's because if the effort to produce more goods and services exceeded the effort needed to get gold, in other words, if the price of things started falling too much, then people would simply go out and get more gold. It was easier to get the gold than it was to produce the stuff. Yeah. And then you end up with too much money relative to the amount of goods and services. And then what happens? The relationship swings the other way. You would get so much gold for producing goods and services that people put down their shovels and picks, they stop mining gold, and they go back to producing real stuff for the economy. And that was a balance that produced a stable price level, at least in this country, from the nation's inception all the way until the creation of the Federal Reserve in 1913. Mm-hmm. We don't have that anymore, obviously. So when we see something like we have today, where M2 is growing and growing faster than normal, it's very disturbing because you're going to get a spike in inflation down the road. If we were theoretically to, let's say, overlay an inflation chart on this, you could see a very clear spike in inflation happen about 18 months or so after you get the big spike in M2. Essentially, there's a lag, is what I'm trying to say, Anthony. There's a lag between when you first have the surge of money creation and then when you actually feel all of the inflationary effects in the economy. So going back to something you said earlier about headwinds in 2025, one of the things that the incoming administration is going to have to deal with is all of the inflationary policies that we've been having over the last couple of years, and not just in terms of Congress and the White House, but what the Fed has been doing as well. In this case, again, they're allowing M2 to grow much too fast, and that means we're going to have more inflation later this year, regardless of what the Fed does today or what Congress and the president do today.
So we have another chart, the M2 annualized change, which I think is pretty telling too. It shows a really big spike, which was decelerating and then now has kicked up. And this basically, before you go into it, just to dumb it down for me, this is just the slosh in the system. This is the too many dollars chasing too few goods scenario that we have continued to create and kind of put our heads in the sand over. And at some point, the train will hit a brick wall, and we kind of seem like we're getting to that point just in time, ironically, for President Trump to take office. But that's kind of what we're saying. We've just created way too many dollars. Then we hid the dollars, and now inflation is spiking and there's nowhere to put the dollars. And that's going to create even more fuel to the fire, which this chart, I think, starts to look at it on an annual basis. And you can see M2 really with a big uptick from, I guess, early 2023 to now, which now the trend is reversed, broke that downtrend and now is heading back up.
Right, exactly. And you just made me think of something when you said this is the slosh in the system. What we were just looking at with M2, think of that as the water level on the shore. And this is the waves coming in and out, right? So the big spike you see, this is like the how big the wave is coming in. And then you see that dip below zero. That's the trough. That's the wave going back out. But now you can see we're back above zero and the wave is coming back in essentially. And one of the things that, one of the reasons why I continue to update this every month and I continue to post it to my X account is the fact that we kept hearing as soon as M2 broke below zero, all these deflation alarmists who were saying, oh my gosh, this only happens like before a depression. You know, the Fed is doing exactly the wrong thing. They need to be creating more money, not allowing money to be extinguished. No, we still have this massive spike that you're never going to be able to erase. And a lot of that money is just recently entering circulation. You know, at the same time, that M2 here, the annual change, you can see that growing by leaps and bounds at rates it never should, because these are not economic growth rates that you would normally see. At the same time, the Fed was quarantining a lot of this money as best it could. Reverse repos hit over $2.5 trillion for crying out loud. But that money is still working its way into the system now. We are still today feeling the inflationary effects of what the Fed did 2.5 years ago. So the idea that we could temporarily, not even for a full year, I guess, have a decrease in the annual change in terms of the money supply, that's not a big deal given where we just were. Again, the previous M2 chart really puts it into context where you have this massive upward spike, a little dip, and then we're right back on the roller coaster. We're heading back up again. So again, the deflation alarmists were wrong. They're pretty much always wrong. The last time the Fed made a mistake in terms of allowing the money supply to decline unintentionally, you have to go all the way back to the early 1930s. So it's been almost 100 years, essentially. It's been over 90 years. They haven't done it ever since then. They've always made the mistake in the opposite direction, which is, again, creating much too much money. And I think one of the, well, I should say two of the fallouts from this, as markets increasingly pick up on the fact that inflation is not dead. In fact, it's getting worse by a lot of measures. This is why, as you already mentioned, Anthony, bond yields have been going up and up. You mentioned the 20-year hitting 5%. I mean, we're basically seeing yields now that we haven't seen since like 2007 or 2008. Correct me if I'm wrong. And at the same time, you're also seeing equities really get hammered. Now, on the one side, people think, okay, inflation should cause the nominal value of equities to rise. And one of the things we've talked about in previous episodes is that sometimes you want to actually give yourself some inflation protection by having more exposure, perhaps, to equities and maybe less on the fixed income side, because at least you'll see that nominal increase in equities with inflation. But I think what markets are really, really focusing on right now is the fact that the Fed, oh my gosh, we're past the election, how times have changed. The Fed has all of a sudden radically shifted their tone back to higher for longer. Yeah. And now equity markets are having to grapple with the fact that the easy money might not be coming back. Maybe not ever. Who knows? At least not in the short run, it's not coming back, which means it's going to be really hard to keep this equity bubble fueled. And so what on the one hand may seem like, okay, there's more inflation, we should have a nominal increase in equities, that seems to be getting outweighed. And again, I would love your input on this, but that seems like it's getting outweighed by the opposite effect, which is higher for longer inflation means higher for longer interest rates, which means lower for longer equity prices.
Yeah, it also means 100% spot on. It also means that the bond market is going to step ahead and be a leading indicator for the equity market and say, if there is going to be higher inflation, then we want to be paid more to lend the government money. So that's why you see yields above 4.5% heading towards 5%. And then the conversation becomes, okay, should I take a risk-free, hypothetically risk-free investment at 5% or 5.5% versus taking risk in the market that's returned annually and it has an annualized historical return of 6%. So you start to create this. The inflation is healthy until it gets to a spot where it's going to hurt the market and money's going to need to be pulled back and tightened, and economic growth and expansion is going to be hurt. At that point, it's not healthy for the equities markets. The bond market's going to compensate, sell down bonds, or demand a higher yield or higher coupon on new bonds. And now it becomes a real conversation as far as where is the better investment, where's the better risk-adjusted investment. And I think that's where we're at right now. The bond market, there's no question, leads the equity markets in times like this. And we've spoken in the past about that Minsky moment, and I think that we are approaching that moment. We've had this massive expansion, easy credit. We've gotten to a peak. Now we're starting to see GDP, which you've proven very, very well in a previous paper that, inflation adjusted GDP is actually negative. GDP is on the fade, and we have now a peak in leverage in credit and in pricing and valuations in the stock market. I think it all leads to a pretty bad, well, it's not the end of the world, but markets are cyclical and bear markets occur. And I think we're kind of there. I want to end, and we'll definitely get into that a little bit more, but that was a great touch on it and lead into it. I love the trend lines, and I love trend line analysis. Obviously, I'm on momentum trend here. You had a trend line analysis for M2. I just want to flash that quick and then slide down to our favorite president in the markets. So this is the M2 trend line, and you can see clearly here coming out of 2019, we completely diverge. We rip off of the line, and we're sitting well above the line now. What gets us back down to trend? And does that even help at this point? How painful is the closing of that gap?
Incredibly painful. Now, the question is just how long is that pain going to last? We forget that there was actually a depression in this country that up until that time was the worst depression we had ever had. It happened in 1920 and 1921, but nobody remembers it. In fact, actually, James Grant wrote a book about this called The Forgotten Depression. Mm-hmm. And the reason no one remembers it is because the government simply did nothing. And in 18 months, the worst depression in our nation's history, again, up until then, cured itself. And then we got the roaring 20s afterwards. And then you fast forward a decade later, and the reason that the Great Depression lasted as long as it did and was as horrible as it was because the government kept trying to intervene and kept messing things up. So, these things are, yes, they're going to be painful, but they don't have to last that long. So what we're basically looking at right now, and actually I'm really glad you brought this one up because not only does it show we're about $3 trillion above the pre-pandemic trend in terms of M2, but also what you can see is the last couple of months there, you'll notice the rate of increase. In other words, the slope of that line, that solid green line, exceeds the slope of the dotted green line beneath it. In other words, the rate of increase the last few months in M2 is greater than the rate of increase in the pre-pandemic trend. So again, this goes back to the Fed is allowing the money supply to grow much too fast right now, especially given where we are in terms of economic growth. Okay, so how on earth do we get back to where we were? Unfortunately, that would mean higher for longer interest rates. It would mean the Fed continuing to sell off more of its balance sheet. Again, all these things are painful. It's going to require some actual, not just disinflation, but deflation. The difference there being disinflation is a slowing in the rate of increase. So it's like you're driving your car at 35 miles an hour instead of 100 miles an hour. Yeah. The prices are still going up. They're just not going up as fast as they were before. That's more or less what we've seen for a couple of years now. We've seen disinflation. Prices are not rising as fast as they did previously, but they're still rising. Anyone who's bought eggs recently knows that. That's if you can even find the eggs. A lot of places are sold out.
Yeah.
But I digress. Deflation would be prices actually coming back down.
Mm-hmm.
And I think the key there is going to be something that Trump has been absolutely hammering on. And now his incoming Treasury Secretary, Scott Bessent, is also hammering on it as well. We have to increase energy production. You increase supply, you decrease price. It's Econ 101. The reason that's so key is the fact that it's not just that everyone uses energy. It's not just that energy affects the price of everything we do and everything we buy. You'll bring down the price of eggs because the farmer, towing the tractors, paying for diesel fuel, the truck that delivered the eggs to the grocery store, that was diesel fuel. The supermarket is keeping the eggs cool in a refrigerator via electricity. That was probably, through coal or natural gas. So all that is true. But we forget that natural gas is a key ingredient. It's, in fact, the number one ingredient in chemical blend stocks in this country. Unlike the rest of the world where they make a lot of their chemicals from oil, we make ours from natural gas because it's so just unbelievably cheap here. So synthetic fertilizer, for example, is synthesized from natural gas. So if you can decrease the price of nat gas, you end up decreasing the price of food because you're decreasing one of the biggest, costliest inputs in food production. So again, you can't undersell, I think, how much bringing down energy prices will bring down prices throughout the economy. Mm-hmm. That will actually help offset a lot of the monetary inflation, we could say, that has been caused by bad Federal Reserve policy. Now, would it have been even better if we had these great energy policies and we never had the last several years worth of inflation? Of course, absolutely. There's no doubt about it, right? However, we are where we are, so we got to deal with that. Yeah. And so kind of a roundabout way to answer your question here, to make a long story endless, Anthony, I think it's going to be painful, but we can diminish a lot of that pain by making the duration shorter, by allowing the market to heal itself, by getting back to sound monetary policy, and also by just kicking everyone else's butt in the rest of the world with unbelievable runaway energy production. And that'll not only help us here at home, it'll put a lot of bad actors around the world like Iran out of business. We forget that although Iran can get oil out of the sand very, very cheaply, they have a huge amount of military expenditures and also welfare expenditures that are attached to every single barrel. Russia, it's very expensive for them to get oil out of Siberia. They have a lot of it, but it's expensive for them to get to. So sure, they can make money at $100 a barrel. They can at 30. Iran can technically make money at prices like 30 or 40 a barrel, but they can't because of all the spending that's attached to it. And so you will bankrupt a government like Iran because of the military and welfare expenditures attached to a barrel of oil, simply by getting energy prices down. So we got to make that happen, I think.
It's amazing to me to listen. You go through it so eloquently, to be honest with you, and you have such a great grasp on the economics and the policy effects. It's amazing to me to listen to you, and it infuriates me, to be honest with you, because the policies of the current administration and the left policies across the board are such a handcuffing of American exceptionalism and American opportunity. I mean, they literally handcuff the United States of America as they're funding or allowing Russia to sell their nat gas via the pipeline to Europe, the Nord Stream pipeline, which was blocked under Trump and then opened under Biden. We allow, or we're literally paying Iran to stay, to function, and to pump oil and to sell that oil. At the same time, we're limiting and restricting drilling and nat gas and fracking in the United States. It's just infuriating that I don't believe that anyone can be knowingly, I don't believe anyone can be that stupid, is the best way for me to put it. There has to be some degree of nefarious angle as to the policies put in and the way they've handcuffed the United States of America, literally broke the legs of America and the American worker. We just need to get back to normal common sense. It's repeated all the time, but it's so nonsensical what we do. Shift gears there to President Trump, who roiled the markets is probably a lot, but kind of sent a shockwave through futures yesterday morning. Thankfully, Island Capital was positioned. We are positioned net short, and we have been since the beginning of December. for good reason. So we kind of came into the day kind of flattish and had a nice P&L day because of it. But Trump talking about tariffs, Trump talking about Greenland. Let's see what he had to say.
It's clear, but have you directed your staff to take specific actions to draw plans? And can you elaborate again? You didn't rule out military coercion.
Well, we need Greenland for national security purposes. I've been told that for a long time, long before I even ran. I mean, people have been talking about it for a long time. You have approximately 45,000 people there. People really don't even know if Denmark has any legal right to it. But if they do, they should give it up because we need it for national security. That's for the free world. I'm talking about protecting the free world. You look at, you don't even need binoculars. You look outside, you have China ships all over the place. You have Russian ships all over the place. We're not letting that happen. We're not letting it happen. And if Denmark wants to get to a conclusion, but nobody knows if they even have any right, title, or interest. The people are going to probably vote for independence or to come into the United States. But if they did do that, then I would tariff Denmark at a very high level.
Have you asked your staff to draw plans for acquisition? I mean, are you actively?
No, we're not at that stage, but we have people. I haven't even entered office yet.
Secondly, sir, Elon Musk has drawn some criticism and a lot of attention for some of.
So I heard Biden is supporting the plan to take over Greenland. He heard they had the best ice cream in the hemisphere, so he's actually in support of it, and he's backing Trump on the plan. The bottom line is this, and it's kind of like it's just like a general. First of all, he's just such a baller because he makes one comment over his eggs Benedict in the morning or his egg McMuffin probably. And the whole Western world is up in arms and everyone's freaking out and the markets are reacting and he's just moving along. And some of what he says is to get a temperature and gauge. And some of what he says is really what he thinks. And all of it has a strategy and a point and a direction. And that's the thing about him that I love. It's like he's literally a Great Dane that walks into a room of Chihuahuas. His presence alone bothers them. And if he even so much as grunts or barks, everybody freaks out. And you know what? It's a great bat to carry because he does it well. Look, as far as Greenland goes, there's 45, 50,000 people there. Just to put it in perspective, their GDP, annual GDP is about $3 billion of fish. And that's not to belittle them, but they have a GDP of about $3 billion versus our GDP of $26 trillion. Strategically, it makes a lot of sense to have the conversation. And if you want to knock Trump for wanting to position or have a national security position in Greenland, then let's knock Russia and China for invading Alaska down and starting to push into our barriers and our sovereign territory, which I know the Dems don't believe in sovereign states anymore, or walls or fences or laws or, even enough water to put out fires. But let's knock the nefarious actors who are actually doing something to create chaos across the globe versus knocking our own leader who is looking to do something to protect the United States and keep peace. I think it makes perfect sense. I think the tariff conversation's so overblown. I'm so tired of everyone freaking out about, is it going to be 30% tariff, 50% tariff? Is it going to spike inflation? The same people responsible for the inflationary policies that we just went through, a large part, the monetary base alone, are the same people criticizing him ahead of time for tariffs that haven't even been put in place. It's just so insane to me. I love the fact that he's thinking outside of the box. I love the fact that there's a direction and a path and a trajectory for his logic and his actions. And I love the fact that the left and everyone else freaks out, and anyone that's associated with or believes in, a socialist new world order freaks out when he enters the room. So guess what? He's got 4 more years in the room. We have the House, we have the Senate. Buckle up because we are going to do what's best for America. And if you don't like it, you can kind of go back in your cave or you can head out, do whatever you want. But these are the things that I think make Trump Trump. And these are the reasons that he won, across the board. And there is a mandate in place for his policies. And I can't wait to get him in office. So that's kind of my take on tariffs and Greenland. And I heard he said when he landed, it's not even that green, but I'm not sure.
Well, that's the art of the deal. That's him negotiating, It's like, wait, this isn't even that green. What are we talking about?
I don't like it. Go ahead.
So, but look, the other thing is, people forget we need Canada and we need Greenland so that we can get an extra 5 armies per turn. I mean, that's just, these are basics here. I can't believe we've forgotten the rules of the game, but whatever. And I'm sitting here laughing, Anthony, because again, art of the deal, he tells Trudeau, hey, you can just become the 51st state. And the whole point of that was him saying, look, if you really don't want any tariffs, if you really want actual free trade, the biggest free trade zone in the world is the United States. All of these individual sovereign states trade with each other and have no tariffs, right? And so this is the only place in the world where you see that. You don't even have that in the European Union, believe it or not. So essentially, what he was saying to Trudeau was, look, basically, if you really want in on this deal, then you got to be in on it entirely. And and obviously being obnoxious, we'll let you be the first governor of not California, of Canada. Well, it turns out Trudeau should have taken him up on the deal because Trudeau's not anything now. He just resigned his prime ministership. Yeah. So voila, art of the deal. It works, I suppose. And look, the other thing is you're absolutely right on everything you said on Greenland. And I think it's also worth pointing out that we spend so much money already effectively protecting them because we have a military base there. This is something that people forget. It's not included in all of the NATO spending, for example, all the military bases we have over Europe, which, ostensibly, okay, they're there to fulfill a different purpose, but they also fulfill the mission of NATO. So why aren't we counting that as part of our NATO contribution? Frankly, same thing with Greenland. Greenland is insanely close to Russia. It's a lot shorter to just go through the Arctic Circle right there to Russia than it is to go, through the North Sea, for example. We forget that we've had air bases there throughout the Cold War, where B-52 bombers were 24/7 taking off and landing, doing patrols over the Arctic Circle, literally for years, waiting for the phone call from the president to say, "Okay, nuke 'em, boys."
Yeah.
I mean, this is again. Our protection of Greenland is a long-standing historical precedent, and maybe it's time we get compensated for it. Is that so much to ask?
Yeah, it's not wrong to be strategic and to be proud and to be protectionist of our nation, of our people. I mean, that's government's first job, is to keep us safe. If this is an angle or a conversation we should have, the Chihuahuas need to stop freaking out. They really do. I'm sick and tired of the little dogs leading the way. So clear the way. The Great Dane has arrived, and I cannot wait. I couldn't be happier about it.
Now, let me ask you though, does the volatility in markets, in other words, the barking of all these Chihuahuas, is that helpful to you in terms of your modeling? Is it disruptive? Is it a neutral? Do you just ride out the big up and down swings that happen in the market when everyone misinterprets something that Trump says?
I would say, and this is really curious, it's a great question, actually. And I would say that a lot of times when the headlines hit, and I say this a lot to other traders, I've been saying it for years, and to investors, the headlines are really interchangeable, meaning what I see in the charts and the way the model is picking up on the emotion in the market, a lot of times I'll see something developing before that headline hits. And I don't know exactly what the headline would be. Case in point was the Fed meeting on the 18th. So Powell said, I always want to call him Bernanke, I don't know why. Basically what Powell said was exactly what the street expected, right? And then we have a 3% sell-off peak to trough that day. Now, my model was short heading into that meeting. I can't tell you what was being picked up on and why the market participants were acting the way they were and why that was creating the signal I got. But I was negative, and it's written in my morning note every morning, so I'm not just saying it. And we were positioned short going into that meeting. And my expectation was we were short. It was going to kind of be a nothing meeting unless he said something out of the ordinary. And I was actually positioning for Q1. Like I was starting to build larger short positions. I had outdated puts out to March. I had started to build, first 20, 30% of the shorts I wanted in the Russell futures and the S&P futures. At that time, I was starting to build my long position in gold, which I wrote about it as well, which is doing very well right now. case in point is that day was nothing different than what was expected, but the Chihuahuas ran to the door and started barking, and we sold off 3%. Great day. Very happy to see it. So sometimes the noise is, exactly what the headline is. It's something very unexpected, and it creates volatility, which is, sometimes it helps, sometimes it doesn't. But for the most part, I would say the model is good at picking up on kind of pre-positioning in the market, heading into an event that is expected to do X. Even if that's not what everyone's talking about or what CNBC is talking about or what some portfolio managers are talking about, the model picks up on what is being done, which is what I like. Where are you investing? Where are you buying? Where are you selling? Where are you, meaning the street? And what is that giving me as far as an output and a signal? So the noise is good for us. I have some core long-term holdings, gold being one of them, but we do trade the volatility and we do trade the signal from our model, and the volatility swings like that. Yeah, they're definitely, on that day I needed a doggy treats for all the Chihuahuas because they definitely helped out for sure. Good segue into the markets. I have two charts to go through today. They're both the S&P 500. The first one is the daily chart. This is just the past couple of months. That gap to the left, I have a red box highlighting there, the gap that's left to quote unquote fill. That gap to the left is November 5th, gapping up to the November 6th. So that November 5th bar, that big up bar, was election day, as everyone started to see the numbers come in and we're more and more confident that Trump was going to win. Trump wins, we gap up November 6th, and then we start to really rip and we hit 6,100 on S&P cash. You can see that top level resistance. The concern I have is we're watching this develop, and what it's becoming to me now is it's really developing as a topping pattern, meaning we hit the top, we consolidated in a topping pattern, and we're going to come back down, versus a consolidation, which would be a continuation pattern, meaning we gap up, we trade constructively within a range, and then we move as momentum and trend continue to improve, hold, improve, break out to the upside. I see this more as a topping pattern. And as we move through, I've been talking about this since early December. As I said, I've been writing about it, and I got a lot of criticism and some hat tips for it, but I could care less either way. We actually had the best month since inception in December as far as P&L goes. So I'm trading the market I see, not necessarily the market I want. That gap down to 5,700 looks to me like it should be filled relatively soon. And by that, I mean in the next week to 2 weeks. I could be totally off, but I think that's where we're at. I'm watching momentum really fade, trend really fade. Volume numbers are bad. Spot VIX, which I watch carefully, has been somewhat unpredictable as it based, and we're starting to see a trend in spiking. And that's another model that I use and mark up for volatility. Obviously, as the VIX is spiking, S&P will come down. And then I look at term structure a lot in VIX. So how spot VIX relates to the futures contracts, front month, second month, third month, will create a curve. We call that term structure. And that curve has been very volatile. Those are all reasons I feel like we are ready to fill this gap to 5,700. We're not in a very strong position, even though we're heading into inauguration, which would be the irony of the move with Trump entering office. And a lot of times we say, like, you sell the news. Mm-hmm. I feel like we might be heading into that event, although my utmost support and confidence is behind President Trump. I don't know that the markets are going to react well over the near term. If we look at the monthly chart, which is the next chart for the S&P that I have to pull up, I have momentum attached to this one. Let me just pull it up real quick. Awesome. So if we look at this monthly chart, we can see a prior peak back in 2022. We had that fade, which was technically a 20% pullback in 2022, right? And then we started to move higher. We had that little blip last August, but we've had a peak, a prior peak, and now the current peak at 6,100. So call it 4,500 and now 6,100. What I would point to is that as price has pushed higher and now really started to fade or stall, momentum hasn't really been able to expand beyond where we were. And that for me is potentially negative divergence, meaning we've pushed the price of the S&P to all-time highs well above the prior peak in 22, but we haven't done so with the momentum and enthusiasm and supporting internals that we would want to see. This to me on a longer term basis, as momentum now on the monthly is starting to turn, still positive, but starting to turn, we now have negative momentum on the S&P, on the daily chart, on the weekly chart, on the monthly chart. So all of the timelines I look at for the first time in a while are all negative or fading. It's not something we want to see. And we definitely are in a position, or I feel we're in a position where the negative momentum daily and weekly is now feeding into a fading momentum monthly. So negative daily, weekly, correct myself, and monthly fading at all-time highs as we're struggling, as we have a gap to fill, as we have major headwinds for the market heading into the first quarter. We can talk about valuations, which we did, inflation-adjusted valuations and the Schiller PE. We're at near all-time highs, which were last seen heading into the tech bubble, the dot-com bubble in 2000. We're just set up in we're set up in a very challenging way. So the way I think about the world is we've come off, let's call it 3% or so from the peak. If I were to be set up short here with reason and wrong, I would be betting 3%. If we break out above prior peak, the trade is clearly off. The positions were wrong. I lose 3%. If I'm right, I think we have 10 to 20 to maybe 30% to the downside. So, a 10 to 1 bet for me is the right position with reason for it. And right now, the model away, my daily model, my weekly model, even my monthly model, all show that we're heading towards lower prices in the near term. Again, I think in the near term, short term, 5,700 on the S&P is a really good target, and that's kind of where we're set up right now.
There's a lot of pain to come, is what you're saying.
I think so. I think, and look, rates are a big deal. The 10-year yield is a huge deal, and no one's watching it until they do, and then it'll be a rush for the exits.
Yeah, exactly. And it really seems like there's so much that is just kind of baked into the cake that we have. Not only have we not at this point taken account of, but that markets for the last several months have not been taking account of. And look, I totally understand the surge in optimism with Trump's election, especially on the small business side. That index itself, the Small Business Optimism Index, it jumped at the fastest rate in a single month since the last time Trump got elected. So clearly people think he's going to be very positive for business. And I do too. It's not that. My issue is, I think going into election day, I think we had an overinflated sense of self. In other words, people were pricing in an economy that frankly has been a fiction. We're going to get in the next month or two a downward revision of like 800,000 non-farm payrolls. Those are jobs that never existed. The Philly Fed, for crying out loud, is now estimating that in the second quarter of last year, we actually didn't have any job growth at all. They think job growth went negative. They think the economy started losing jobs almost a year ago. So again, it seems like markets had, as Greenspan said, irrational exuberance going into election day. They then became even more optimistic with Trump's election. And the question is just at what point, I think, do markets finally realize, things may get better eventually, but tomorrow's optimism does not pay today's bills.
No, it's well said. It's well said. I think we're at that point. That's really well said. We'll definitely start to keep up the markets as we, I make a call like that. It's a significant call, so we'll keep up on a week to week where I'm at. My daily note is out every day at islandcapitalinvestments.com and on X at CMT_Anthony. So anyone can look at that if they'd like. I know we're very short on time. I just want to say, I know, obviously the fires in California, to be rivaled by the flooding in Western North Carolina. We'll get into it next week because it's kind of a hot story and developing, but obviously prayers go out with everyone in California and in North Carolina across the board. And I think that we need to really look at, and I'd like to look at actually next time, we're going to take some clips of the failures of our leadership, the failures of policy, not only monetary and fiscal policy, but just the failures of policy across the board, which all lead into just a feeling of weakness and insecurity in the country right now that needs to be fixed. And we're seeing front and center how poor leadership and just a lack of a lack of intelligence is really harmful and hurting the American people and the American economy and America herself. So we'll definitely get into that
Amen.
next week.
And Anthony, my big fear is, and again, like you said, we can talk about this next week, but my big fear is that all of the wrong-headed policymakers that helped contribute to this disaster, really cause it, are going to get in the way of recovery. You wouldn't believe how many homes in California have basically been grandfathered into existence. In other words, they were built a decade or even 5 decades ago, and it's illegal to build those same types of homes today because of all kinds of government regulation. I don't know how people are going to recover from this. Even if they had insurance, I don't know how they're going to be able to afford to rebuild a home.
Yeah.
Do you owe citizens an apology for being absent while their homes were burning? Do you regret cutting the fire department budget by millions of dollars, Madam Mayor? Have you nothing to say today?
Can you back up, boss? Appreciate it.
Have you absolutely nothing to say to the citizens today? Elon Musk says that you're utterly incompetent. Are you considering your position? Madam Mayor, have you absolutely nothing to say to the citizens today who are dealing with this disaster? No apology for them? Do you think you should have been visiting Ghana while this was unfolding back home?
Yeah, I think the best thing she did and the smartest thing she's probably done her entire life is keep her mouth shut right there, because she has nothing to say.
What is the situation with
and
water?
the
Obviously,
inability.
in Palisades ran out last night in the hydrants. I was talking to the firefighter on this block. They left because there was no water in the hydrant here.
The local folks are trying to figure that out. I mean, just when you have a system that's not dissimilar to what we've seen in other extraordinarily large-scale fires, whether it be pipe, electricity, or whether it just be the complete overwhelm of the system. I mean, those hydrants are typical for 2 or 3 fires, maybe 1 fire. You have something at this scale, but again, that's going to be determined by the local.
They didn't magically increase the number of fire trucks pumping water out of hydrants. Like, it's just what an absolutely nonsensical thing to say. He's acting like, all of a sudden there are millions of fire engines pumping water out of the hydrants. No, there's the same number of fire engines that there were before. There's no water because you sent it all out to the ocean with your stupid environmental regulations that effectively made it illegal for people to keep any of that water in reservoirs from snow melt coming off of mountains. I mean, this is absolutely obscene. The people who literally, the literal arsonists are pretending to be literal firemen today.
Yep. And the fact that they're cutting budget and then redirecting that money towards illegals is another part of the problem that's unspoken. So, Newsom, the way he does, he'll be part of the problem and then part of the solution. And that's not, the American people cannot continue to be this ignorant and put these people in office. They are destroying the country. They're destroying the locales, the states, and the country across the board. It's too incompetent to not be on purpose. I guess that's the best way I can put it. And it's infuriating that he thinks he can stand up there and actually give an excuse and blame the locals for the fact that they've put policies in place that have not only prevented them from being able to avoid with the lack of deforestation, the lack of control and management, it's prevented them from being able to handle the emergency. And then on top of it, because of their incompetence, the homeowners aren't able to get insurance policies to cover their homes because of the risks created by the government. Like, honestly, it's infuriating, and it's we need to wake up. We need to wake up. For California, for that locale to be a Democrat left-leaning location, those districts need to wake up. Those states need to wake up. Look at what's going on and be aware, because this is it's a literal destruction. It's the burning of Rome. It literally is. Rome is burning around him, and he has a reason as to why it's not his fault. That's a shame.
Amen, Reverend.
EJ, have a great weekend. I know we're towards the end of the week. We'll see you next week. Thank you as always.
Till then, Anthony, my pleasure.